Blue bars, of course, show the history and IHS's November forecast, and the gray bars show their February forecast. Now, if you look back in the history to 2020, to last year, you can note that wage and salary income actually grew. This is US level. Wage and salary income actually grew 1.3% last year, even as US unemployment peaked last spring at near 15%. For wage income to grow in the same year that so many people lost their jobs illustrates the unevenness of last year's employment and income losses, when low-wage workers were much more likely to lose jobs than high-wage workers. The last 2 years have seen a decline in the U.S. labor force participation rate, as workers have opted out of employment for a variety of reasons, including difficulties finding affordable and accessible childcare, lingering COVID-related safety concerns, early retirement, and trading employment for starting a business. In October of this year, the U.S. labor force participation rate was 61.6%, well below the 63.4% prior to the pandemic. IHS expects the tightening labor market, and by a tight labor market, I mean low unemployment and a high demand for workers. IHS expects that tightening labor market to drive up wage and salary income. They now expect strong wage income growth of 8% this year, up from 6.7% in February, followed by only a small deceleration to 7.9% next year. The forecast for wage and salary income has been revised upward significantly for the remainder of our planning horizon. This chart shows levels or dollar values, so not growth rates this time, of U.S. corporate profits. This is the main factor determining Minnesota's corporate tax revenues. The solid line shows IHS's November outlook, and the dashed line shows what they expected in February. Corporate profits were unexpectedly strong during the first half of 21, driving higher than expected corporate tax receipts at the federal level, among U.S. states, and in Minnesota. And those unexpectedly strong corporate profits also drive an increase in the corporate profits forecast looking forward. In this outlook, corporate profits are expected to grow 19% this year. That's nearly 4 times the rate forecast in February. Moving to Minnesota's labor market, this chart shows the official unemployment rates for Minnesota and the U.S. Minnesota is the dark line, the U.S. is the light line. You can see in the unemployment rate chart, and first of all, the vertical gray bars are for the U.S. recessions. So you can see the very skinny gray bar in 2020 because it's been dated as just a 2-month recession in 2020. And then you can see the sharp spikes during that recession in unemployment last year when Minnesota's unemployment rate reached 11.3%. As of October, the state's unemployment rate is at 3.5%. 1.1 percentage points below the U.S. unemployment rate, and the 14th lowest among states. Now, of course, the overall unemployment rate does not capture the full labor market story. It masks important differences between groups, and it doesn't reflect Minnesotans who have left the labor force, again, including retirements, and those staying home to care for children or who traded jobs for entrepreneurship. Since the onset of the pandemic, Minnesota's labor force has fallen by 84,000. As of October, Minnesota's labor force participation rate was 67.8%, 2.4 percentage points lower than in February of 20. Despite the fact that the labor force participation rate for Minnesota has fallen, it remains high relative to the U.S. It's 6.2 percentage points above the U.S. rate, and it is the 5th highest among U.S. states. So as with the U.S. forecast, we expect low unemployment and high demand for workers in Minnesota to drive up total wage and salary income in the state. For another view of the state labor market, this chart illustrates total employment. So the line is the total number of workers in jobs in Minnesota, starting at 2.5 million and moving up, and starting with the end of the last recession moving forward. The chart illustrates the increased slope, or the slope of the line from 2009 forward illustrates the steady job growth in Minnesota since the last recession. And then in March and April of last year, as the pandemic was taking hold, Minnesota abruptly lost 416,000 jobs, approximately 14% of February 2020 employment. Since then, state employers have added jobs in most months. Through October of this year, 296,000 of the jobs lost have been recovered. Minnesota employment is now 121,000, or 4.4% lower than in February of 20. I'll turn now to the revenue forecast. The first two columns of this table show actual receipts at the close of the prior biennium, the 2021 biennium, and the change from the prior estimate. And the next two columns show the current forecast and the forecast change for the current biennium. I mentioned that income, consumer spending, and corporate profits all grew more in calendar years 20 and 21 than had been expected. This drove extraordinary revenue growth in fiscal year 21, which ended with revenues $2.775 billion ahead of our February forecast. This is the bulk of that 3.1 carry forward from last biennium to the current biennium that Commissioner Showalter described. Moving to the second two columns, higher tax receipts to date, so far in fiscal year 22, and an improved outlook for income, consumer spending, and profits raised the revenue forecast for fiscal years 22 and 23. Total general fund revenues for the current biennium are now forecast to be $5.13 billion more than the February forecast. We've raised the forecast for all the major tax types. Individual income tax receipts are now forecast to be $2.7 billion more than the prior forecast. A higher estimate for tax liability in 20, which is the base year of this forecast. So we had higher receipts than expected in fiscal year 21. That was largely due to higher tax liability in calendar year 20, higher than what we had estimated prior. So that higher base year liability, combined with higher growth in wage and non-wage income, raised the income tax forecast for the remainder of fiscal years 22 and 23. The non-wage income that had forecasts go up, that had higher growth, were in particular business income and capital gains realizations. Sales tax revenue is now forecast to be $821 million more than the prior forecast. The higher forecast is consistent with the increased growth in consumer spending I've already showed you, and also due to higher collections so far this fiscal year. The forecast is reduced by $359 million for eliminating the June general sales tax acceleration that the Commissioner mentioned. The corporate tax is projected to generate $1.249 billion more than the prior estimate, based on that higher forecast for corporate profits I showed you and higher collections so far this fiscal year. Let me reiterate some of the risks to this forecast. I've mentioned that the economic forecast depends on the path of the pandemic, including the impact of the Omicron variant and any other new coronavirus variants or treatments. The assumption embedded in this forecast that inflation settles back into the 2% range at the end of next year depends on the resolution of supply chain blockages and on an increase in labor force participation over the next 2 years. Higher or more persistent inflation could change the timing of expected actions by the Federal Reserve. Those supply chain disruptions and the pandemic, of course, both threaten growth in other countries. Slower than forecast economic growth in some of the United States' major trading partners could reduce demand for U.S. goods and cause our economy to grow more slowly than forecast. And finally, with 19 months remaining until the end of the 22-23 biennium, so we're just at the beginning of that biennium, even small changes in assumed rates of growth in important revenue sources can have big changes in the budget outlook for this biennium and the next. So I'll now turn it over to State Budget Director Anna Minge.
Thanks, Dr. Kolombakidis, and good morning, everyone. I'm Anna Minge, State Budget Director with Minnesota Management and Budget. Let's move on to talk about the changes on the expenditure side of our forecast. This slide outlines changes in general fund spending in the recently closed biennium, as well as in the current biennium. Now, as you heard from the Commissioner, Changes in fiscal year 2021 are meaningful because they are part of the balance that carried forward into fiscal year 2022 and contribute to our projected surplus. Overall, spending changes are relatively small, about 0.7% in both the previous biennium and the current. So let's start by discussing the changes in 2021. The first line, E12 education, is the largest area of the state general fund budget. And there we saw $84 million in lower spending as a result of fewer than expected pupils. The next line, health and human services spending, was $102 million below end of session estimates. This is largely the result of underspending in agency operating and grant appropriations, as well as lower spending in the state medical assistance program. Spending for property tax aids and credits, the next line, is $80 million below end of session estimates. Much of this is a result of reallocating general fund spending on business relief grants to federal coronavirus relief funds. I'd like to expand on that for a second. Early in the pandemic, Minnesota committed significant general fund resources to respond to COVID-19. And although we made these investments quickly, we did so with a mindful eye to fiscal responsibility. As funding became available through the federal government, MMB looked for opportunities to reallocate previous expenditures to those federal resources and provide relief to the general fund. The changes on this line are just one example of that effort. All other areas of the state budget combined had $65 million in lower spending, but much of this is underspending in areas of the budget that carried forward into fiscal year 2022. Now moving on to the two columns on the right-hand side, the changes in the current biennium. In the fiscal year 2022-23 biennium, total spending is forecast to be $364 million, or about 0.7% lower than end of session estimates. The largest change is in E12 education, where we see a reduction of $326 million from previous estimates. The state education forecast has been updated to account for declining growth in our student population. New data and improved methods have resulted in refined estimates, which drive general fund savings. The next line, Health and Human Services, is $94 million lower than end of session estimates. And a large driver of this change is lower enrollment in the state's child care assistance program during the COVID-19 pandemic. But that lower utilization is not expected to continue at 2022 levels. State spending on property tax aids and credits is also lower in fiscal year 22-23 as a result of lower projected spending for renters' property tax refunds. In the next line, our debt service forecast is also below previous projections due to lower bond rates and updated cash flow needs for existing bonding projects. Now, the last line, all other areas of the state budget, are combined $136 million above previous estimates. This is primarily due to those appropriations that carried forward from 2021 into 2022, where they're reflected as spent for the purposes of this forecast. But this line also includes a $30 million contingent appropriation to the disaster contingency account at the Department of Public Safety. Let's move on to discuss changes in the general fund budget reserve. This chart illustrates the growth in our general fund reserve balance in recent years, with the light blue bars highlighting changes in this forecast. As you can see, with this forecast, our current budget reserve balance is $2.656 billion in fiscal year 2022. As a result of our improved general fund forecast, we allocate additional funds to the general fund budget reserve, reaching the statutory target established under Minnesota's nation-leading budget reserve policy. Since 2014, Minnesota has had a budget reserve target based on an annual analysis of revenue volatility. State law directs 33% of a November forecast balance to the reserve until that target is met. Our current target is 4.8% of general fund revenues in the current biennium. As you can see on the chart, in the last forecast, represented by those dark blue bars, we projected a decline in the general fund budget reserve from 2021 to 2022. This is a result of two provisions enacted by the 2019 legislature, which resulted in $591 million moving from the reserve and into the general fund. However, the 2021 legislature directed that the first dollar of any future forecast surplus be redirected to the budget reserve until it returned to $2.377 billion. Today's positive news fully restores the reserve to $2.377 billion by buying back that $591 million. But on top of that, it results in the deposit of another $279 million, the amount necessary to meet the budget reserve target. So in total, this forecast results in an $870 million increase to the general fund budget reserve in fiscal year 2022. And with these increases, we achieve the targets set in state law. Now I'll turn it back to Commissioner Showalter.
Thank you, Anna. A couple of notes on the long-term outlook as we wrap up and move to Q&A. As mentioned earlier in the briefing, the revenue improvement is not one time. It continues over the forecast horizon. With revenue growth exceeding projected spending growth, we keep structural balance all the way into fiscal years 24 and 25. Of course, this comparison does not add into our spending projections of the impact of inflation, which is more than $1.16 billion for the next biennium. As goods and services become more expensive, this means $1.16 billion less in current services in that biennium. And as anyone reading the news or buying a car, doing most anything these days knows, inflation also cuts into today's purchasing power. So this current law forecast is based on enacted appropriations. So there's no estimate of inflation or the bite of inflation on current activity. The last couple of years have been tumultuous. Today's forecast shows that the state's economy is emerging in a good place. It's not an accident. There's a lot of work that's gone into this. Quick thanks all around. Thanks to workers and businesses who've continued to adapt and thrive as we've dealt with an ongoing pandemic. Thanks to the state workers and nonprofit organizations that help deliver on urgent needs. Thanks to the parents and teachers who figured out how to keep teaching their kids one way or another. Thanks to the businesses who kept struggling to keep their doors open. Special thanks to healthcare workers, public healthcare workers, those on the front line who've been taking care of our sick, helping keep the rest of us safe. Thanks to the policymakers who supported our budget reserve, who enacted smart tax policies that have been resilient, and directed an injection of federal cash into Minnesota that allowed us to weather this crisis without cutting services for those who needed them most. I also want to thank the team at MMB, who helped manage our state resources in times of uncertainty, and not only put together this forecast, but helped contribute to the savings that are reflected here in how they managed the COVID response financing. Way to go. We got here through a lot of hard work and a lot of caring and a lot of tough decisions. If we keep that up, today's surplus can keep on creating good news for Minnesotans for a long time to come. Thank you. Happy to take questions.
Commissioner over here.
All right.
I'm not sure who wants to take this question, but I want you to explore a little bit how much of this is a Minnesota phenomenon and how much of this is a national phenomenon. Meaning, if we were in capitals across the country right now hearing similar presentations from similar budget directors, would we be hearing significantly different information than we're hearing from you today?
Excellent question. You want to take it? Come on up.
The extraordinary revenue growth that we saw in fiscal year 21 and the improved forecasts for fiscal years 22 and 23, that's something that is consistent with what we're seeing in other states. Also, the forecast change, adjusting the forecast through the pandemic, that's something that's consistent both with what other states have done and what the Congressional Budget Office has done with regard to forecasting federal receipts. So it's a consistent story all around. Some of the things that are unique about Minnesota, one is that we have a tax revenue system that was well situated to capture tax receipts from the extraordinary growth that we've seen in the last couple of years. So having a progressive income tax, a general sales tax, and a corporate income tax allowed us to as I said, capture some of that growth.
Commissioner.
I had a question about how the federal legislation has factored into some of the national forecast stuff and how it might trickle down to Minnesota. I think this question might be for the state economist. So you'd mentioned that in the national forecast, the impact of the recently signed infrastructure law was accounted for, and I think we've talked about how the past COVID stimulus has also helped shore up the state's budget. So I'm curious what you might expect to see if we see the signing of a federal package like the Build Back Better Act, and how that could further affect the state's budget forecast and economic outlook.
Yes, so the economic growth coming out through the pandemic into 2021, a lot of that was supported by some of the federal deficit financed federal fiscal stimulus that occurred in those years. As you reiterated, the Infrastructure Investment and Jobs Act impacts are incorporated into IHS's U.S. economic outlook here, and so that's reflected in our Minnesota economic outlook. The Build Back Better reconciliation bill is not yet reflected because IHS wasn't sure enough what it was going to look like and what the impacts might be. That one, if it has significant pay-fors, then if it's not deficit financed, then it might have less of a national fiscal stimulus effect than what we saw prior.
Commissioner behind the cameras here. Just so I understand what's in hand versus what might materialize, even if things went sideways after today, there's $4 billion in the bank for policymakers to divvy up in the upcoming session. Am I reading that correctly?
Right now, we have about $3.1 billion in addition to what we were expecting in the bank. So that's kind of what the portion of the surplus that's basically in the bank right now.
So what's the total number? 3.1 is
Looking at the, go back to the slide, I'll show it to you. So you're seeing the beginning balance. Basically, you see the forecast change. Oh, I see rather than the forecast change, the total amount in the bank. Yeah. So sorry, $3.9 billion basically is what we're expecting. No, I take that back. No. Sorry, Brian. What you're looking at is $7 billion essentially is resources in the bank before you take out reserves, before you take out other things. So right now, we have about $3.1 billion of this surplus that's essentially money in the bank.
My question is for the state budget director, if you could tackle this question about the education spending. The report, and you'd mentioned earlier that there was new data and improved methods that resulted in different projection from past forecasts. If you could elaborate on what that means, was there some incorrect method, or I guess I'm curious about how that happened.
Sure. So there were, in the projections for the 22-23 biennium, we based those off of actual enrollment for fiscal year 2020. And what the data indicated was that growth from fiscal year 19 to 20 was much lower than recent trends. It grew at just 0.2%. And that really brought down the base for the entire forecast. We also had a correction in how we align data between birth years and the year of enrollment beginning, which also had an effect on the forecast. But the biggest impact was the change in the 2020 actuals.
So is that due to declining birth rate?
I think that's certainly a trend that we've seen over time, that birth rate has been declining. There are a lot of factors that go into whether a student shows up to enroll in public schools, but certainly birth rate is something we've been monitoring that has been falling over time.
So to follow up, because I think in the past forecast, I think there's been a note about how parents might have pulled students from schools because of the pandemic to homeschool or for other reasons. Is that something that is still happening or showing in any of the data? Like, are we still seeing pandemic-related drops in school enrollment?
So when we look, that's a great question. When you look at the change in E12 education on this slide in the 2020-21 biennium, that is largely an impact of pandemic factors, where and there has been a slight adjustment. There's an assumption about the impact of the pandemic going forward, but that really is focused on 2021 and 2022, and then tapers off over time.
So it's more due to the drop in birth rates going forward than pandemic effects.
Yeah.
So if I can just get a big picture clarification, and I think this is for the state economist, the impact of all the federal money is more in the economy writ large than it is in the state's general fund coffers. The economy writ large and the enhanced receipts and profits that we got from taxes is the direct cause of our huge surplus forecast. Am I right or not?
Well, I'll start, and then you can jump in. I don't know about you said more related to this and less related to that, so I'm not sure about the order of magnitude here. But the economic outlook, the improved economic outlook, looking back from the beginning of the pandemic to now, was supported, that was helped by very large amounts of federal fiscal stimulus spending to households and businesses. And that allowed some businesses to stay open and continue to employ people. The additional federal unemployment benefits were extremely important to workers throughout the country, but here in Minnesota, and that helped maintain our tax revenues throughout. So that was payments, the federal payments, the stimulus payments to businesses and workers in Minnesota. Now, federal payments to the state would be your department.
It's a great question, and probably there'll be a couple of dissertations on that at some point, because really it's a what if this didn't happen. I think what really we're seeing is that the confidence that was expected to be engendered by federal stimulus, by federal support of state actions of responding to needs on the ground, had their desired effect, both in Minnesota and elsewhere. Certainly, last session, we had a lot more opportunity